Hi, and welcome to our end of June update from the Wealthy Doctor Institute, Physicians Leading Physicians Through Finance. We work with physicians and other busy professionals who are not happy with their current investing strategy. We help them get this part of their lives handled so they feel empowered and in control. I'm David Ye, and in my book, The Busy Doctor's Investment Guide, I show you just a few ways where just a few adjustments each year can help build and protect wealth. All of the strategies in this book are easy to calculate each month. For those of you new to the concepts in this book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So this month's the end of June, so this is the 6-month review of our systems. Remember, we do not micromanage our systems. In other words, there's no point in watching the markets every day, let alone every week or month, except to make those calculations or check those indicators. But every so often, it's nice to do an internal audit about how things are going. This would be true in any endeavor, whether or not you have a personal small business or big corporation or even your own personal finances. Even when you have someone else doing your books for you, don't abdicate, stay engaged. So this month, we're staying engaged and looking back at how we've been doing the last 6 months. Then we'll review our system, starting with our 20-month moving average system. Then, usually we would review the MRI system. However, this month we have an announcement. Then we'll remind ourselves of the rules for the 25% stop loss system. Then monitor the free sector surfer strategy that comes with every subscription. And if you notice, I'm shortening this video. I did my own internal review of how effective my videos have been, and it looks like very few people actually go through the entire video, so I'm going to see if I can make more shorter videos to keep your interest. So this video, I'll just stick with a 6-month review and review of our systems. So, to review our systems, the first system is the 20-month simple moving average system. That's abbreviated to 20-month SMA. So, for this system, all it does is we take a look at the S&P 500 index. You can use the index fund or the actual index. I use the index fund, dividend corrected. As long as this is above the 20-month moving average, it's relatively safe to stay invested in the index fund. Otherwise, get out. So remember, the 20-month moving average is our safety belt. It only works if we actually use it. That means we watch it once a month. Not more often, not less often. So here's a graphical representation of the fund versus the simple moving average. So the blue line, the jagged line, is the Vanguard S&P 500 Index Mutual Fund. That's the one with most data. So I can show backtest results as well as going forward. And then the red line is a smoother 20-month moving average. Every dot on this line represents the average price of the mutual fund for the last 20 months. And if we take a look at this month, as of June 30th, the index fund ended at $250.99 per share. The moving average ended at $229.55. So while the index fund barely squeaked up, because the markets have been on a tear for the last several months, the moving average continues to go up more. So if you take a look at a quick and dirty calculation, current price of the index, current price of the moving average, we have a 9.3% cushion. In other words, if the index drops up to 9.3% by the end of next month, we're still relatively safe to be in the markets. Otherwise, next month, if it goes below, we'll get out. So, of course, I've also been talking about Sector Surfer. Sector Surfer uses something called Storm Guard Armor. It's a more sophisticated filter. Basically, the 20-month moving average is a first-order filter. It only uses one variable, whereas the Storm Guard Armor uses a 3-variable filter to give us signals that tend to be a little bit more reliable than the 20-month moving average. Nothing is perfect. We're not aiming for perfection. We're aiming to at least mitigate the larger bear markets. And if we take a look at Storm Guard Armor this month, we're still in the S&P 500 index. And if we take a look at the actual indicator itself, you see how Storm Guard Armor has been very close to our zero line, but not quite, and this month it actually went up just a smidge. All this means is that for now, we're still relatively safe to be in stocks. So the observations for this month. The S&P 500 index gained this month, minimally for now, and the 20-month moving average continues to signal a relatively safe zone in the stock market. Similarly, Sector Surfer's Stormguard Armor also says we're in safety zone, and although it's very close to the danger zone, until it crosses, we stay in the markets. Remember, this system is not designed to catch peaks. Markets must fall enough for our system to fill any criteria for a danger zone. And for people who actually like numbers, here are 3 columns of numbers, starting with the S&P 500 Index Mutual Fund, dividend corrected, versus switching between stocks and bonds using the 20-month moving average, versus using Stormguard Armor to switch. I've highlighted all the years where there were losses in red just to make it easy for our eyes to gaze. You can freeze this pane on a video and peruse these numbers yourself. But so far over the years, just by switching out of the markets when it's dangerous, the 20-month moving average has been annualizing approximately 1% more than the S&P 500 index, which results in a 40% increase over buy, hold, and reinvesting mutual fund just because of that 1% difference over the years. Little things mean a lot over time. Time is your friend if you start early. If you haven't been investing by now, start now. Meanwhile, looking at Stormguard Armor, because it's been making more than 3% annualized over the 20-month moving average, we've actually been making almost 2.5 times more using Stormguard Armor. So again, 3% difference doesn't seem like much, but over time can mean a lot. And again, just another graphical comparison between the systems. The blue line here is the S&P 500 Index Mutual Fund. The red line here is the Long-Term Treasury Bond Fund. This green line here is using Stormguard Armor to switch between the two. And you can see pretty much all we're doing is cutting out the big bear markets. And then if we can improve on it just a little bit with a better filter with Stormguard Armor, we get this purple line. So the next system is the Monthly Rotation Investment System, abbreviated to MRI. Now, when I wrote my book, this was my flagship system. This system proved that algorithmic systematic rotation can outperform buy, hold, and reinvest. In fact, I only used 3 funds, so it wasn't too complicated. And yet now, I'm making the painful decision to discontinue coverage of the system just because Sector Surfer rotation is so much easier and tends to be more robust, at least in backtesting. So just to remind yourself of what the MRI was, every month just rank 3 different mutual funds: the S&P 500 Index Mutual Fund, the Emerging Markets Mutual Fund, and the Inverse S&P Fund Mutual Fund. So by definition, if you have an index fund and an inverse fund, one of these must be going up. So every month, rank these 3 funds, sell the bottom 25% of your portfolio, and buy the top fund. So yes, using MRI, it is better than buy, hold, reinvest, and rebalance. In other words, modern portfolio theory. However, Sector Surfer outperforms MRI, and unlike the 20-month moving average versus Stormguard Armor before, the MRI is not an easy pen and paper alternative system for the typical layman. And although I used to use this as a flagship, I myself have discontinued using MRI as published in my book myself in favor of Sector Surfer, and I've yet to hear from any of my followers whether or not they're still using MRI either. So, as an author, it pains me to admit that MRI, my flagship baby, is obsolete, which is actually a good thing, which goes to show that it's not a good idea to rest on your laurels and stay in your rut. Be open to new ideas, but test them. Don't just take any new idea. Make sure that whatever you're doing new is somehow better than what you used to be doing. Otherwise, it's not called progress anymore. So here's the Sector Surfer rotation of these 3 mutual funds. You notice how there is no Stormguard Armor for this because we already have an inverse fund that helps take care of our bear market. So just by rotating among these 3 funds, holding one fund at a time, trading maybe once every couple of years or so, we can increase our returns to approximately 15% per year with a much smoother graph than buy, holding, reinvesting the S&P 500 index, giving us only 9.5% annualized return over the last 24 years. Now, for the foreseeable near-term future at least, I'll keep monitoring this particular portfolio just because I want to demonstrate that even without Storm Guard armor, there are ways to mitigate bear market risk. However, as a disclaimer, all the systems I use incorporate Storm Guard armor, which this system doesn't qualify. So for this month, the MRI is still in the emerging markets, even though the emerging markets has relatively tanked compared to the S&P 500 index. So you can see how the S&P 500 index did go up for half a month and has been trending down, but it's still barely positive for the month, whereas the inverse fund is barely negative, and the emerging markets has been going down. Now, this can't be due to trade war yet because the trade wars hasn't really taken effect. So you know that a lot of this reaction is psychological among investors. And that's why we use filters. Trying to anticipate the effects of news is a fool's errand, especially since by the time we lay people get the news, it's already old news. And most of the time that there are market moves, there are no big news items that could possibly be psychologically moving the markets. So when we use a mechanical rotation system, we let the markets tell us what to do. So the observations for this month: the US stock market barely gained this month, while the emerging markets continue to lose ground. Sector Server continues to be in the emerging markets. It has not yet met criteria to switch out yet. I would not second guess Sector Server if you're using Sector Server. If you disregard your own system signals, you don't have a system. So the next system we'll cover is the 25% trailing stop loss system. So the 25% trailing stop loss system works like this. If you really want to buy a stock for some reason, limit risk of that one stock to 1% of your total trading portfolio. So if you have a 25% trailing stop loss, that means you can use up to 4% of your account to buy that stock. This way, if it loses 25%, you only lose 1%. Get it? And then when you buy that stock, immediately enter a 25% trailing stop loss order. Now, normally you can either just hold until it gets stopped out, or if the stock goes up by 33%, you can go ahead and buy another block of stocks using another 4% of your account. Because by the time the stock goes up 33%, if it drops 25%, you've essentially neutralized your 1% risk. So this is why you can go ahead and use another 4% of your account to buy another lot of stocks, and then update your trailing stop loss order to reflect the increased number of shares. And just keep doing that until you're finally stopped out. Eventually, when bear markets hit, your stop loss will be hit. So our next system is your own Sector Server system. Now, I can't review your Sector Server system because only you have a Sector Server system. You put in which funds or ETFs or whatever has a ticker symbol that you want in your particular universe, and for many of us, our 401k plans and 403b plans have only a limited number of choices that we can use. And just to quickly review, Sector Server has two main tools. It has a filter to help figure out if it's relatively safe or dangerous to be in the stock market. Kind of like my 20-month moving average, only more robust, but trades more often. And then you have a sector rotation mechanism that tries to optimize the momentum during either bull or bear markets. Now, I've gone through some of these other nuances when constructing portfolios. The site has a pretty good online instruction manual, including videos. Feel free to reach out to them or reach out to me. And remember, Sector Server is almost a set it and forget it system. When a signal is generated, it will either text or email you every day until you log in and see what trade you're supposed to make. Once you make that trade, you click on that red acknowledge button. It'll turn to a green done button with the date that you did it, and Sector Server will leave you alone until the next signal. Now, for those of you who complain that, well, that means it's a black box, the good news about Sector Server is that the mechanics are, at least theoretically, easy to understand. You can just go online and look up how Sector Server works. There's nothing mystical about it. Unlike if you go to some of these so-called professional investment advisors, you ask them what their formulas are for investing, and they refuse to disclose, even if you offer to sign a non-disclosure agreement. Sector Server is fairly transparent. Now, Sector Server is relatively easy to use. If set up properly, it will text you, it will email you with a signal, and it'll keep signaling every day until you log in and see what adjustment you're supposed to make. Once you make it, you click on the red Acknowledge button, it'll turn to green Done button with the date that you did it, and then Sector Server will leave you alone until the next signal. Now for me, because I manage several systems with several clients, I log in approximately once a week at least, just to make sure I'm not missing any signals. If you only have 1 or 2 systems in place, it might be overkill for you. But it couldn't hurt. So here's the example free Sector Server strategy that comes with your account. The free strategies are okay, but if you know some of the nuances, you can definitely improve on them. However, if you improve on them, you will pay $10 a month for each strategy. But at least we can follow this example free strategy, where all it does is take these 6 Fidelity funds and trades maybe around 5 times per year on average, uses an earlier version of StormGuard called StormGuard Acute Quick Response, and goes into bonds when it's relatively dangerous with stocks. So this month we actually have a trade alert, and here's what the alert says. If you log on to Sector Server, it says examples free strategy on this date and month, sell the Fidelity Worldwide and buy the Fidelity Small Cap. Once you go ahead and make that trade, you can click on this red Acknowledge button. It turns in this green Done button, says done this date, and then you can go back to your life. So in summary, what we've covered so far, I'm trying for shorter but more frequent videos. The end of month videos are typically the ones where I actually analyze the steps. The 6-month summary of our system so far. We've covered the 20-month moving average system, the MRI system, including why I'm no longer going to cover the MRI system, dealing with stock tips, and covering the sample-free Sector Server strategy. Remember, this strategy, among other strategies, had trade alerts this month. So if you haven't received one yet, you might want to log into your Sector Server account and see if you have any trade signals that you somehow missed. So keep those questions coming. I know I talk to several of you personally every month, and I realize that for some of you, these video updates are not enough. Especially if you're unhappy with the current investing strategy or lack of strategy. I'm going to offer a complimentary investment wellness checkup and breakthrough session. During this consultation, we'll work towards creating a sense of clarity about the financial future you really want, why you're investing to begin with, discuss the essential investing building blocks for your particular situation, then determine what has stopped you from having the investment results that you've been wanting to get, and then identify the actions you can take that may move you towards your financial goals that you desire. Then we'll complete our discussion with the excitement of knowing exactly what to do next to create the financial future you really want. Think CME, only the topic is financial and tailored to your particular situation. Think wellness checkup, because whether or not you feel financially well, if you had a financial cancer or blind spot you didn't know about, wouldn't you want to know about it so you can deal with it before it grows and metastasizes and blows up? Don't be bashful reaching out. The more you delay, the more time is against you. So, until next month, invest safely.